Hey everybody, welcome to this free edition of our Trader User Group weekly roundup for the trading week ending April 14th, 2022. I'm Preston Brent. Thanks for tuning in. Well, in this holiday shortened week, we had a lot of activity, but net, the markets ended up moving lower. Let's kind of break out where I see the markets doing right now. So let's just kind of zoom in a little bit here. Let me just take a look at the weekly sound bites. We'll look at the index performance first. Just see. You can see here everybody was in the red with the exception of the Russell, right? Kind of ended down most of the week. It was a holiday shortened week, as I'd said. And we saw some of the first release of some of the major banks this past week. The banks are having a tough time of it. Value stocks continue to outperform growth. Okay. Small caps, though, did rebound, or I can't talk. Small caps did regain some lost ground. You can see the Russell in the red or green this week, 59 basis points up. Everybody else was in the red. NASDAQ really got hit hard, but we're still in official correction territory, as you can see, both on NASDAQ and the Russell, over 10% to the downside. S&P and Dow still in the red firmly this year. Now, this past Friday, markets were closed in observance of Good Friday. We're going to see a lot of markets closed even on Monday, especially around Europe. But we're looking at a sharp deceleration in earnings growth. That tends to be one factor weighing on consumer sentiment. FactSet came out with their earnings estimates, and they expect profits for S&P to have grown in the mid-single digits over the year from prior year, but still the slowest pace since 2020. But the year-over-year comps are going to be hard to hit because last year profits were up dramatically off of the 2020 COVID bounce, right? So what I believe we're going to continue to see a slowing of the economy. Now, headline inflation, if we just kind of take a look at some of the economic data, headline inflation jumped about 1.2% in March, came up to 8.5%. And the PPI, the producer price index, came in at 11.2%, which means they're still withholding some of the price hikes to the end consumer. But I suspect that's going to go away, and you're going to continue to see price hikes at the consumer level. Meantime, retail sales rose very slightly in March, but that wasn't adjusted for inflation. So retail sales are coming in slow. And then, of course, we got on the Treasury side and the Fed side, we did see the Chicago Fed President, Charles Evans, who's kind of historically been seen as a dove. In an event in Detroit, he said he considers an accelerated pace of rate hikes are certainly worth debating. He's coming in a little bit harder than he normally is. So we're seeing treasuries moving, everybody's moving. Now, for our members, we've been playing the interest rate move really well. We're doing great in that trade. So members just hang on to the trade. I suggested in our chat room ways to even add to that trade as we move forward. Okay. Now, of course, if we come over and we look at Europe, you can see over in Europe kind of a mixed bag, but generally down, much like our markets this past week. You can see the Euro stocks, the FTSE, the DAX, all in the red for the week. CAC 40 was the only one slightly in the green, but the only one green year to date out of all the major indexes that we follow is the FTSE over in London. It's up 3.14%. You can see that the central bank did not adopt a more hawkish stance at its policy meeting, meaning they didn't hike the rates. They indicated at this meeting this past week that they're going to adhere to its earlier guidance for a steady withdrawal of their stimulus, but they did leave their current rates untouched at 0%. Okay, and there's really no clear timetable for when they're going to start raising the rates. Of course, Europe is getting hit harder with the invasion in Ukraine by Russia than we are here because it's on their eastern border. And they got a bigger issue with their energy policies on a go-forward basis. So I think Europe is going to be a lot weaker than the U.S., clearly this year anyway. And meanwhile, further to the west in Europe, the UK, their economy showed signs of faltering a little bit while inflation continued to accelerate. Over in the UK, their inflation print this past week showed a 30-year high of 7% from the prior month 6.2. So everybody is fighting inflation. Everybody. Okay. And I think inflation is going to last a little bit longer than people thought. Last year, when Boom Boom Powell, the Fed chair, came out and said inflation is transitory, I came out with a comment that I said, yeah, even dinosaurs was transitory, but it depends on your time frame. So they now have backed off the term transitory, but it's going to put them in a pickle. So we'll see where that goes. Meanwhile, the Bank of Japan, they're continuing to maintain their massive monetary stimulus to support their very fragile post-COVID recovery. And their PPI, like Europe, rose by 9.5% year over year in March. So they're still faced with bouts of inflation. And then over in China, you can see they were down for the week 1.25. They're in correction territory at 11.77 for the year, down. China is still got a huge surging COVID crisis, especially in Shanghai. It's like, what, 23 million people live in that city. So that's going to also hurt supply chain disruptions, which is going to dovetail over to Europe and, of course, to our shores here in the U.S. So we can expect supply chain issues, higher inflation, certainly through the summer months. Okay. China's CPI data also accelerated in March. So inflation is a worldwide phenomenon. You just can't go turning the lights out everywhere across the planet, i.e. shutdowns in the economies, and then turn it back on 90 days, 120 days later and expect no particular outcome and no bad consequences. And to add to that, all the massive amounts of money, these balance sheets that the central banks are holding have expanded dramatically. Here in the U.S., we're up to about 9 trillion in our balance sheet. And they're going to start reducing it. But our national debt here in the U.S. is about 29 trillion. That's an unheard of number. Okay. Our debt to GDP is around 1.3. It's at all-time highs. And for about every 1% that our rates move up, that adds about 290 billion interest expense to our debt. It's going to be crazy. I think the Feds are going to be in a pickle. All right. They're dramatically pickle is what I would call it. So that's a little bit at a really high level, just skimming the surface on this holiday weekend. What I see, net, I see growth slowing. I see the markets in a wider range chop. I do see a little bit of a lift in the markets over the next 6 weeks, but I think the year is going to be tough. Okay, it's going to be really tough. And members, we're not going to be meeting tomorrow night. We're off holidays for the weekend with Easter tomorrow. So hopefully everybody will enjoy a nice weekend break, clear the head, spend time with the family, that kind of thing. What I'm going to do is I'm going to shift the screen over and I will show you the E-mini S&P 500 futures, just so that you guys can get an idea of the key levels. We broke through a major key level in the S&P. Now, is it a sign of bad things to come? I don't know, but it could be. And if it is, that means we're going to see some more downside here. So what do I mean by that? Well, if you look at the chart, you can see I kind of stepped it back just a little bit. You can see on the chart the regression channel that has moved left to right, lower. And we broke out of the regression channel. And at the same time, you see this yellow line, which is the 200 EMA, and the red line, which is the 50 EMA. I thought they were going to cross, but this counter-cyclical move was so strong, it flattened the 50 EMA and actually moved it up a little bit. Not enough to really change much the trajectory in the 200 EMA. It's running about flat right now. But you can see here where we got up, we actually cleared this prior pivot high over here. It converted it. It was such a strong move, this impulse move, it gave it an Elliott Wave 3 pattern. Now this can shift, but right now, that would suggest we're going to pull back and then move higher, forming an Elliott Wave 5 closer to the 2021 closing price. But this script is not done just yet, okay? You can see here, and let me just blow it up so that you can see price action a little bit tighter here. Let me just do it like this here so you can see. you can see that we fell hard. You can see over here, 4 days, we were sitting around the 50 EMA. 3 days actually, and on the fourth day we gave it up, found support at the 200. And it held us up going into Thursday, and then going into Thursday's close, we gave it all up, and we're now below the 200 EMA. So right now, all prices in the S&P below the 200 EMA, below the 50 EMA, but the 50 EMA is above the 200. So this is looks like a buy the dip opportunity short term. We're going to get a lot of earnings next week. Members at our pre-market trader session on Wednesday before the markets open, we'll go into some of the detail on how the earnings are faring and are they beating, and just what the beat rate is and what it means for price action. But we can see where we're sitting right now. We're in a very tenuous position. And the reason why is, let me show you the Dow. That's the best performing index right now in the US. If we look at the Dow, you can see the 50 is below the 200. It's parallel in it, but it's below the 200. You can see the price action closed below the 50. So when price is below the 50 is below the 200. That's a bear market looking chart. Okay. So we've got the 50 below the 200 in the Dow. And if we look at the Russell, it looks a lot uglier. Let me just find the rut on here. Where are we here? Let's see. Here we go, right here. The rut had a really ugly day. It was one of the ugliest days in the market. It was down over 2.3%. Look at the 50 in relation to the 200. The 50 is moving away from the 200 to the downside. Price action is below both. Okay, now we hit a low back over here on March 15th. We were actually in bear market territory intraday before we came back and closed up around 13,460, right? So that was a big moving day. But look at the price right now, okay? And notice here, the Elliott wave count is an Elliott wave to the downside. And then you got an Elliott wave 4 and a target range down here of about 12,479, which would suggest we're going to take out the 2022 lows. And it would also suggest that technology, at least the NASDAQ 100, is going to possibly move back into bear market territory again. Now, as I said, the script is not finalized because this can change on a dime with earnings. But obviously, technology does not like higher interest rates, and interest rates have moved up dramatically. That is taking the wind out of the sails for the technology shares. We've seen this since fourth quarter of last year. Okay, we had a good heads up on that for our members, and we were doing our allocations and playing those shares that made the most sense. And we're in the green year to date on our trades, especially some of the strategies we're using in the options market. And this is what's going on with NASDAQ. Now look at the Russell. It's even uglier, even though it was the only market to finish in the green this past week. We got a 200 EMA that's declining. We got a 50 EMA that's declining and also below the 200. And price action is below both of them. We were down almost 23.5% back over here on February 24th, okay? And that is a bear market chart. Again, a bear market chart is when the 50 is below the 200. Price action typically will run up to the 50 and or the 200, find resistance and roll back over below both of them again. And you can see how we set at the 50 EMA literally from March 18th through about April the 5th. For about 3 weeks, we sat here before we finally gave it up. So obviously a test of the 50 EMA is going to be in order. But if you think about it, we've got the Dow, the NASDAQ 100 future, NASDAQ 100, and Russell 2000, all with the 50 EMA below the 200 EMA. Bear market looking charts. The S&P 500 is the only chart where the 50 is above the 200, but that was starting to falter on Thursday going into close. So it's very difficult to run a bear market chart in one or two or three indexes, and the other index is the lone holdout. Eventually, they all go together. So we're either going to see this downside action stop, consolidate, and grind higher over the next 60 days, or we're going to see the S&P give it up, and now you've got bear market looking charts, which means every rally is a sell into rally, not a buy the dip kind of thing on a move lower. So we're going to get more information coming out over the next 2 weeks on the earnings to see just where we are. Everybody's paying particular attention not only to where earnings come in Q1, but what's the forward guidance. And so far, over 70% of the companies that have reported have stressed inflation and cost of goods going up as being a primary factor, which means profit margins are going to start to go down, earnings per share are going to start to go down. Now, I think the analysts are a little bit over optimistic about going into the end of this year. The analysts are forecasting end of 2022 earnings per share being around 228 a share, right, or earn $228. That's a lot, all right? That's not quite 10% earnings growth. That's like 8% earnings growth. I don't see it right now. I really don't. Inflation and price at the consumer retail shelf has not gone up, and they've not been able to push through the difference in the PPI, which is cost at the wholesale level, or what the businesses and manufacturers are paying. Eventually, they're going to have to push those prices through to the consumer. That's going to drive prices up, and the consumer's not going to buy as much. The only thing that's saving us right now is the consumers have deep pockets from being holed up for a year and a half. So if you look at the airline industry, if you look at the cruise industry, you look at hospitality, you look at services, they're all up this summer. In fact, Delta came out with strong earnings, one of their best, Q1s in a long time, because people are itching to get out and spend money. Now, how long will that last? Hard to say. But the more expensive gasoline, the more expensive food, and all these other services, as producers start increasing their prices on the shelf, then we're going to see it's going to affect earnings per share because people aren't buying as much. Margins are going to go down. You're going to see margin compression, and then I just think it's going to be uglier than what the analysts are forecasting right now. Either way, members, we'll be following it very closely, and we'll be able to see how all of this stuff starts to shake out. Okay. If we look over at the Fang Index, this is an index of just the Fang stocks. You can see we're down almost at the lows that we hit back over here in March 8th, okay, when we were down almost 30% just with the Fangs. So Microsoft, Facebook, Apple, Netflix, Google, Amazon are getting crushed with these higher interest rates. And I don't see it letting up, guys. And this does not mean everybody's rushing to sell all of their Google or Amazon or Apple stock. All right, good stock. Same thing with Microsoft. Good stock, but they're just reducing their allocation and moving it into value shares, utilities, dividend paying kind of stocks like that. So it's just a reallocation here. I mean, the only bright side I saw on Thursday with that move lower into close was that the VIX did not really go batshit crazy to the upside. The VIX was up on the day about 88 cents. And with 50 some odd points to the downside in the S&P and over 300 plus points in NASDAQ to the downside, told me that it's just not, the markets are just looking at this more from a reallocation standpoint right now. And folks, you got to remember, for the past decade or so, interest rates have been 0%. So technology and growth stocks is where you've been wanting to stay and hang out. And you can just throw a dart at a board and make money in growth stocks over the past 10 to 15 years. But that's all changing. We're going to operate in a new paradigm, a new economic regime. And those things that worked before will not be working right now. So members following, if you follow us and what we're doing fairly well. We're making money. We're actually in the green for the year. So that's kind of what's going on. If we look at the VIX, like I said, it was only up 88 cents on the day, on a really ugly day. But we're still below the 50 EMA in the VIX. We're still in the red, the lower light red, which is kind of what I view as a down fast market. but and remember, a down fast market also includes a choppy market as well. So that's kind of where we're sitting. Let's look at treasuries for a minute. The bond market cratered on Friday. I mean, it was just ugly, ugly, ugly. It fell over 2 full handles. And if I look at this, I got to reset this thing. It was 140.24, right? So if we come in here and I set it, I hate it when it does that. Yeah, there we go. Not quite there yet. This just mixed me. There we go. So that was the low on Friday. We went all the way through my projected low, which is really projections for Q1. We've blown through it. Okay, totally blew through it. So this is going to be the resistance point trying to climb higher, but it's ugly, ugly, ugly. Now we've been playing other ETFs to the downside, and we've made a killing in this move, this play. The easiest way to play it is with options in the bond futures market. Okay, that would have been the easy play. Already back over here, we were getting short the bonds at 160, and bonds are at 141 right now. So call it 20 handles, and it's $1,000 a handle. So you're down 20. That's 20 grand per contract in profits. Okay. We got out right here, and I suggested this was a sell the rally kind of mode. Profit taking here, get back in up here, and then it's just been hold on to this roller coaster. It's been rolling over ever since. I would not chase it if you miss this move. I think we're going to have a little bit of a bounce here, but we're still in an Elliott wave 3 down that suggests we're going to go lower. Okay, just to give you a little bit of a longer term target. If I move it out here like this, 136.18, we almost hit it. We're very close to it. Okay, this is on a weekly chart. And if you look at this weekly chart, you can see this huge, strong support price zone here like this. And we've been moving down dramatically. We started the big move back over here on January the 4th. And this is when I was calling it out because that's when I put the regression channel on here, right? Right around the 4th of January, once we broke and started going lower. And then every rally, I've been saying you got to sell the rally. And notice each rally, we've been making lower highs. Okay. It's classic bear market chart, right? 50 EMA. And this is a weekly chart. I got to go back to the daily to classify the 50 cross below the 200, but it crossed below on January the 7th. And like I said, this has just been one of these kind of moves here that we started adding to this thing really nicely. But you can see back over here on January of the 21st, this is when it really started. Now, you could probably argue it started back here, starting to go down before COVID, right? And then we had that big move lower in the COVID. But net, this is where you want to be. You want to be short this thing. Not right now. If you're not short now, like I said, just sit and wait. But you definitely want to sell the rallies in the bond market. Okay. And there's a number of ETFs that you can play to make that happen. Okay. If we look at interest rates, look at the 10-year, guys. I mean, this is insane. And I got to recalibrate here too. We're making new highs in interest rates almost every day. So if we look at the high here, 2.835. Okay, almost just slightly under 3%. My original resistance point was back over here. So we're well into this move higher on the interest rates. And notice here that it's still an Elliott wave 3, right? That means we can go a lot higher. I think it's going to climb up. Once it hits over 3%, then it's going to start to get ugly. I would not chase this here. I would expect a little bit of a pullback, a dip, some profit taking. Notice there is no divergences here, so that suggests any pullback, you're going to want to buy the dip, which means you're going to want to short bonds if it has a counter-cyclical move to the upside. Okay. So that's kind of where we're going. And look at the euro. The euro at some point is going to really take off, but right now it is not. Okay. It is just getting ugly, ugly, ugly. And if we look at it, my target for the euro is down around 107. Let me just see what we're sitting at right here. It's at 107.8. So it's actually, right, let's see here. Right there is kind of where we're sitting right now. 107.810, right? And my target was to hit it the end of this month. So you can see we hit my initial target here. It served as resistance. And then here's my next target down here. It's going to give us an LA wave 5, possibly divergence. And that would be a good opportunity to maybe buy the dip and play the counter-cyclical rally to the upside. Let me just put you guys on mute just for 1 second here. Hang on 1 second here. I get this here set up. All right, sorry guys. So this is where we're sitting. If we look at gold, gold is going to slowly move higher. I like this movement here a little bit every day. Okay. I believe it's going to take the 2078 out over time, but I do like the move. Silver, same thing. Excuse me. I like the move in silver also. Longer term, you want to be long gold, you want to be long silver. Okay. If we come down here and we look at oil, now we've got a special way of trading oil. It's working out really well for us. I believe oil is going to grind in a wider range. Members will go through again. I'll review that in our next session. The best way to put a trade on in oil, it's the same thing that we're doing in gold. All right, a good play. All right, just a really good play. Nat gas, again, up strong on Friday. Look at this chart, guys. We got into nat gas down here. That's a bullish chart if I ever saw one. I don't like nat gas normally moves like this right here. It has a big spike up, it comes down, it's very choppy, and then it ends up back down here again. And what happens here is you get a lot of shorts that get run. Shorts have run out now, and now we've got it repositioned with longs coming in. I do believe we're going to start to run into some resistance here. If we put it on a weekly chart, you can see we've cleared some key areas. And let me just move this. You can see right here we've cleared this key zone. And if I back it out even more so that you guys can see, you can see this key zone right here. So that is going to be our support point right around 6.5 in the futures market. But you can see this move, just how this is all because Europe is going to be getting off Russian gas. This was an easy trade in my mind, or what we call a low-hanging fruit trade. The minute we knew that policy was going into effect, you wanted to get into gas companies, or you could play the gas futures market. But gas companies, you can collect dividends and play these things. And it's been a good run. Okay, just a really good run. Pipeline companies with nat gas. That's where I see these guys going. Okay. And if I really step it out, just to show you just how crazy this is, but where it can go. Back over here, back in 2008, nat gas was at $13. So do we have some more upside? Absolutely. I think it's going to get up slowly over $10, and it could run up even more. Nat gas, the all-time highs for nat gas were 15.44 in the futures market back in 2005. I think this little move so far that we've had is right here. So we've got a lot of upside. Now, it's not going to come without dips and counter-cyclical moves and everything, but longer term, it's going to run. All right, it will run. And I see that happening. So you need to position yourself in it because it's a beautiful looking chart for the bulls. Okay. And there's a reason for it. With Europe trying to get off and wean themselves from Russian natural gas, which is even harder than weaning yourself from Russian oil, right? So that's a little bit about what I see in the energy market. Now we've got some movement in agriculture and in the softs market, but this is kind of where we're sitting, guys, for this holiday weekend brief update. Net, watch the earnings next week. Watch the forward guidance. We got 3 bear market looking charts. The S&P is if it folds and gives it up, then I think we got more downside. If it holds, we see the other charts grind up. We could see a grind through the end of this month. Earnings are the only thing that should do that. There is no other big news out. We've got the CPI and the PPI numbers out. The next big news hitting outside of earnings is coming May the 4th with the next Fed meeting. All right, so that should be really, get your popcorn out. That's going to be a wild one. All right, everybody, have a great holiday weekend. Members, I will see you Monday in our chat room. Take care, folks.